Hello everybody, welcome back to this Introduction to Investing course. Hopefully you somewhat enjoyed the last video on bonds. Bonds are not as exciting as stocks in my opinion, but I do hope that you at least learn something there. As I always do, I hope that these videos are at least providing you with some sort of educational value. But today we're diving right back into stocks, and this is going to be a pretty important video. I really want you to pay attention to this one because today we're talking about stock buying strategies, and in particular, we're going to be talking a lot about risk today. Sorry about that. But yes, we're going to be talking a lot about risk today, which I think is something that I think a lot of you are concerned about. So hopefully this video will address those concerns a bit. So starting off strong, we're going to start off with a very important concept. I don't want to risk losing you, so we're starting off very important with the idea of diversification. You may recall, I believe I did talk a little bit about it in the second video, Introduction to Stocks, and I did say that I would talk about it. I did say I would talk about it more later on. So here we go. Diversification. We really want to highlight the idea of risk here. This is the way to avoid risk, the way to minimize risk. The diversification in general is just buying many different stocks. Buy many different stocks from many different industries. So why does this help minimize risk? Well, you want a portfolio that is very well diversified, because if one stock in your portfolio goes down a lot during one day, you want many other stocks that can balance it out and help mitigate the impact to that stock. So and the many different industries part is very important because there are like many instances that can happen where where an entire industry can be hit very heavily, and you want other industries to be able to balance it out. For example, if you want to talk, the tragedy of 9/11. It was a very tragic day, and on that day, I'd imagine, although obviously there are much bigger issues to worry about than the stock market. But I'd imagine a lot of airline companies' stocks would have fallen down that day because of what happened. So if you invested only in airline stocks, you would have lost a lot of money that day, which obviously would not be a big concern based on what else is going on in the world at the time. But it's just I'm using that as an extreme example. If you invested heavily in airline industries, you would have lost a lot of money. But if you branched out into other industries, like maybe tech or maybe healthcare, then it wouldn't have had that much of an impact because you have these other industries that could balance out the heavy losses that the airline industry would have taken. So that is, I hate to start off with that on a sad note, but I think it is a good example of why diversification is important. So this, of course, I really want to highlight diversification. I think it's very important in investing to mitigate the risk that you take when you invest. So I wanted to spend a good amount of time to drill that in. You'll hear this a lot. If you recall, I talked about ETFs and mutual funds in the second video at the very end. And the reason why those are so safe is because of diversification, because they invest in many different stocks, and they can balance. And so when one goes down, many others can balance it out. Same with indices, like I talked about in that video. So hopefully that's ringing a bell, and hopefully you now understand better why ETFs are so safe to invest into, because of that balancing effect. I do want to tie back into Ronald Reed. If you recall, in the first video, I mentioned a lot of case studies, and Ronald Reed is one of them. Ronald Reed actually was very heavily diversified. He had, I think, 95 different stocks, all in many different industries, and there was he invested in a very big bank at the time called Lehman Brothers. Uh, Here, I'll just make a note in case you're curious on Ronald Reed. He invested. The company is called, I'm not too sure to pronounce it, Lehman, but this company, Lehman Brothers, very big bank at the time, and so he invested in it. And then in 2008, there was a huge financial crash, called the Great Recession, and a lot of big banks collapsed, and Lehman Brothers was one of them, and they went bankrupt. So the stock that Lehman Brothers had was completely useless, completely worthless after they went bankrupt. And Ronald Reed owned a significant amount of Lehman Brothers stock, but he was still able to get that $8 million by the time that he died, because he was so heavily diversified that even when this company went bankrupt, completely bankrupt, and the stock went from, like, I don't know how much it was at, but it went from that, it was probably a lot because Lehman Brothers was huge. It was like one of the biggest banks in America, and it went from however much it cost to zero, and it didn't even impact him that much because he was so heavily diversified in many different stocks that it didn't have much of an impact. So that, I just wanted to bring that example to show you how powerful and important diversifying your portfolio is. Hopefully that helps show you a bit. Now I want to take a little bit of a step back and talk about something that's not really related to risk, but still good terms to know. That is a market versus a limit order. This is more related to when you buy stocks rather than the strategy of picking stocks. This is when you actually, like, go to your broker and buy it. Let's make a little chart here. When you buying stocks can be a pretty scary thing, so I want to give you as much knowledge about it as I can so that you feel more comfortable. So a market order is when you buy the stock at whatever the current price is. So your broker, when you buy it, use a market order, then your broker is going to price the stock automatically and immediately. So a benefit of this is that it's going to go, your order is going to go through immediately, because the pricing, it prices whatever the broker wants, whatever the price of the stock is at right now. So your order is going to be guaranteed to go through. I can't really spell it. Guaranteed to go through. However, the drawback of this is that you have no control over what price you buy it at. Obviously, you'll see at the time, like, maybe the stock costs $60, but in the time that it takes to look at that price and then actually place the order, then the price could jump to, like, maybe $70, and you could be paying a lot more than you wanted to, because you have no control over what it costs. It's when you place a market order, it's entirely based on what the market price is right now, and the market price can be very volatile. It can change very quickly, and so you have no control over what the price actually ends up being. The benefit of that, of course, is that, of course, your order is going to be guaranteed to. You're going to be able to buy the stock no matter what, because it's whatever price happens to be in the market right now. And you'll understand a little bit more when I talk about limits. So a limit order is you buy the stock at a price that you choose. So you choose the price, and this can be like an exact price, like $5, or it can be a range as well. So maybe, like, you could just buy, like, at $5 or less than $5. You can have that as well. So that is, of course, you know, you can see it's the opposite of the market here, because the market, you have zero control over what the price is. Here you choose exactly what you want it to be. However, the drawback, of course, we're going to look to the opposite of what this is that it can be very, very difficult to actually purchase a stock if no one wants to sell a stock to you at the price that you want to buy it at. So, so the order might not even go through. For example, if you want to buy the stock at $5, but there's no one willing to sell it to you for $5, then let's say everybody wants to sell the stock at $7, but you want to buy it at 5. You're not going to be able to buy the stock because no one's going to be willing to sell it to you at the price that you want it to be at. So the order's not going to go through. You're not going to buy the stock. If you do a market order, then if you buy at market price, then you'll just buy it at $7 because everybody wants to sell at $7. You'll just buy it at $7. There's nothing stopping you from buying it. For limits, there is. So that hopefully clarifies the difference. You can see there's this crisscross effect between the benefits and costs of both. Whenever you choose one of these orders, you gain one thing and lose another thing. So you want to be careful of that. To help you sort of choose which order to use, there's this rule of thumb is that you want to use the market order when you just want to buy the stock and you don't really care what price you buy it at. If you do very detailed research, which we'll talk about next video, and you find a stock that you are really interested in buying, and so you're just like, oh, I just want to own this stock, don't really care what it costs me, then you can use a market order. And then use the limit order if there's a very specific price that you want to buy it at. Another thing to keep in mind is that stocks with high volume. If you remember, I talked about volume in the intro to stocks video. If there's a lot of people that are buying and selling the stock, then it'll be a lot easier to have an order go through, because there's so many orders going through that chances are somebody's going to want to sell you the stock at the price that you want to buy it at. So if the volume is very high, or high volume. If the volume is very high, then you can probably get away with using a limit order. If the volume is low, however, and there's not many people that are selling the stock, then the market order is going to be probably the better choice because it's just going to be hard to find a buyer or to find a seller that wants to sell at the same price that you want it to buy at. For limits, that's not going to be the case. So that's also another thing to keep in mind. So that's market limits. Now let's dive a bit more back into the actual strategies of buying and selling stocks. This next one is a very, very common one, a very, very important one, called buy and hold. You might be able to guess what this means just from the name, but it's just buying a stock that you're really confident in, you've done in-depth research, you're like, yeah, I know the stock's going to be really good, and you want to hold it for many years. So yet again, investors show off their incredible creativity and named it buy and hold, but at least it helps you remember the name much easier. It helps you remember what to do with it. So buying and holding is a very, very popular strategy, but it can also be pretty hard to do because you have to be able to hold on through a lot of fluctuations. Sometimes these can even be recessions, like say 2008. There was that Great Recession. Stocks collapsed between 2008 and 2009. The stock market got absolutely pummeled. It was not pretty, and You might even remember that time. It was not an easy time for a lot of people. But if you're buying and holding, a lot of people panic sold their stocks during that time, and they sold stocks that they'd held because they were like, oh no, the stock market's crashing. I gotta take profits now. But someone who buys and holds, they're not gonna do that. They're gonna keep holding on to their stocks during this big crash and wait for the recession to pass. And by now, the stock price would be much higher than it was at the time of 2008. So if you held it on, if you held the stock from through this big recession, you would have made a lot of money if the stock kept going up, which a lot of stocks did. If you did your research well and held on to it, then you would have recovered a lot of the money that you lost during 2008. So you really you need to be very strong if you're going to be doing this strategy. You have to be able to be confident in your decision of buying the stock and be like, yeah, I did the research. I know that this stock is going to be really good to hold on to, and you want to be able to withstand these short-term dips. And the reason why this is so powerful, this idea of buy and hold, is because stocks in general go up over time. If you remember what I said in the Intro to Stocks video when I talked about indices, an index, they're used to track the performance of the overall market, right? So if you go and look at the performance of the S&P 500, for example, over time, you'll see a very, very steady increase over time. And because the S&P 500 represents 500 big stocks, then you'll know that in general, these stocks are going to go up a lot. Stocks in general go up a lot, and they can create a massive, massive return over time. And so it's no surprise that this buy and hold strategy is endorsed by many, many famous investors. A name that you probably have heard of if you haven't already. His name is Warren Buffett. Why they considered the GOAT of investing, the greatest investor of all time. Warren Buffett, huge name. He's one of the richest people in the world, and he endorses a strategy of buying and holding and it's made him billions and billions of dollars. But also some names that maybe aren't so big. Ronald Reed, all the people, the case studies that I mentioned in the first video, Ronald Reed, Ann Schreiber, Mary Ellen Pleasant, they all bought stocks and then held them for a long period of time, and were able to make millions and millions and millions using this strategy. So it requires a lot of strength and confidence, but you really, really reap the rewards of it. I want to follow up this by talking about a very important distinction between stocks. Two very common categorizations is growth. We'll make another chart for this. Growth stocks versus value stocks. Growth, pretty straightforward. You might be able to guess what it is. Growth is just stocks that are expected to grow very, very fast in the short term. In the short term, stocks they grow a lot in the short term. Their long-term prospects are a bit cloudy, but you'll see them grow very, very fast. And if you want some, and there are a lot of good examples of growth stocks. There's an acronym of the five very, very common ones, five very big ones. It's called FANG. FAANG. F is Facebook. The two A's are Apple and Amazon. N is Netflix, and G is Google. These are some very, very, very common tech growth stocks. Tech stocks in general usually are growth stocks. Most growth stocks are typically technology, because tech stocks, they've grown a lot over the past 20 years. Sometimes you'll see the N substituted for Microsoft, but FANG doesn't sound as good, so we just call it FANG. But Microsoft is also a really, really great growth stock that you may have heard of. So that's growth. A lot of very big names in growth. Value is different. Value is a bit more complicated to understand. I'll give a definition right now, but chances are you might not understand what it is. So value stocks are stocks that they trade at a lower value than what they're worth, than what they are actually worth. That probably makes zero sense to you right now. And what this is called is fundamental analysis. I'll put that right here. This is going to be the focus of the next video. It's a very, very dense topic, and I'm going to be spending a lot of time on it in the next video. But fundamental analysis works as a preview. It works to try to figure out, based on numbers, on quantitative and qualitative figures. It tries to figure out what the company is actually worth. I'll provide an example to you if this doesn't make sense to you. Let's say there's gold. Let's take gold for example. Gold, I don't know the exact number. I think it's worth about $18,000 per pound. I'm not sure on that though. Let's just say that for now. I will double check that later and then put it in like the caption if I'm wrong here, which I probably am. But I believe it's $18 per pound of gold. So let's say, so this is the true value of gold right now. So let's say you were given the chance to buy gold at $1,000 per pound. That's a dang bargain. So this is essentially what value investors do. They see a stock that is they're like, maybe this is the word that they use is undervalued. They see a stock that's worth less than what they think it should be worth, and so they buy it and then wait for it to go up, so that and they wait for it to go up so that they can reap the true value of what the stock actually is. So and what you are aiming for here is long-term growth. So I'll illustrate based on a brief graph. So growth stocks, typically you'll see them look like that. A lot of exponential growth. You'll see they start off pretty slow, but they'll gain a lot of speed and then grow a lot in a very, very short amount of time. Value stocks are going to look more like this. So it's not this rapid growth that the growth stocks have, but it's very, very consistent over time. And growth stocks this is pretty important. They're pretty risky, right? Because if they're growing a lot over time, in a very, very short amount of time, then there's going to be a lot of risk involved in that. Chances are they're going to have a lot of debt. There's a very heavy chance that they could go bankrupt. But you also see a lot of reward in a short amount of time. There's again that idea of high risk, high reward keeps coming up. Same here. For value stocks, they're usually less risky. And they're gonna grow very slowly, but they're gonna gain a lot of value over time. I do want to make a note here that history shows that typically over the long run, value stocks are gonna outperform growth stocks. Over a long period of time. But that doesn't mean that this is like typically, but this is all based on what you want to do. Honestly, personally, I like investing in growth stocks more. I think growth stocks typically are a better thing to do right now in the short term. So that's what I like to do. But this is all based on your preference. I will not be making that decision for you. That's what you want to do based on research. So that's growth and value. It's a really big idea that I did want to put a bit of time into. Next up. Dividend investing. You can probably guess what that is, just based on the name. You want to invest primarily in stocks that can pay good dividends. And typically, typically these stocks are going to be value stocks. Reason being, I think I might have talked about this in the intro stocks video, but typically growth stocks, because they're growing a lot in the short term, they need as much money as they can get, and they have no money to waste on dividends. Value stocks, on the other hand, they don't need this massive influx of cash so they can grow very quickly. They're like slow and steady, right? Slow and steady wins the race. And so they have this money to give out to investors in the form of dividends. So typically you'll see value stocks giving out really good dividends. And the point of dividend investing is not to create this windfall, this like gold mine over time. The goal of dividend investing is to create a steady and a reliable source of income, right? Dividends are very consistent, and it will pay you a consistent stream of income. But the flip side is that you're not going to see rapid growth because growth stocks don't typically pay good dividends. I do want to note that Ronald Reed was a dividend investor. He bought a lot of stocks that paid really good dividends, and he used the dividends that he got to buy more stock. That's called reinvesting your dividends. You're reinvesting the money that you get into the stock market to earn more money. And I think I saw a source. I'm not sure how accurate this is because it's honestly pretty crazy. But I saw that a source that said that he was able to earn a monthly income of $20,000 per month, just on dividends, which is pretty crazy. But that was what he was able to do. That sounds a little bit far-fetched to me, but I'm not sure how accurate that is. But that's pretty crazy. Some examples of dividends, of good dividend stocks that I'll throw out there. AT&T is really, really good. They pay a really high dividend. Coca-Cola is a classic example, made famous by Warren Buffett, which I talked about earlier. He's very famous for his Coca-Cola investment. Made a lot of money from that. So yeah, those are a couple famous examples of dividend stocks. This next one is another way to mitigate risk. I keep coming back to that. It's a very common, a very big deal. It's called dollar cost averaging. Often abbreviated DCA. I'm going to start this one too because, again, risk. Really want to keep an eye on that. What dollar cost averaging is, you want to buy small amounts of stock at regular intervals. So you might not get what that means, but this is in opposition. This is as opposed to buying a bunch of stock at once. So instead of buying instead of say you want to buy like 100 stocks of Apple, instead of buying all 100 shares at once, say you could buy 25 shares at like 2-week intervals. And the reason why you do this is because it seems kind of crazy, right? But the reason you do this is to reduce the risk of volatility. What do I mean by this? Well, I said that the stock market in general moves up over time, but of course there's going to be fluctuations. So typically, the market will go up. That is the general trend, but of course there's going to be dips and peaks. So there's always that volatility in the market. So what dollar cost averaging tries to do is, say you could have bought that 100 shares of Apple at this peak here, where it would cost you a lot of money. And so instead of doing that, you are buying, say, 25 shares here. But then over the next 2 weeks, it could drop down to here, and you buy again here. So you see it averages out. That cost averages out into this general trend line. So you're paying a lot less than you would have if you just bought everything over here. Now, of course, there's that risk that if you if you buy everything here, you get a good bargain. And then if you do dollar cost averaging, you'll buy it up here. You'll buy some more shares up here, and it'll average out to a higher cost than you would have paid originally. But if you do this, if you do dollar cost averaging over time, like a lot of it, then you'll see that greatly reduced. You'll see a greatly reduced cost, and it really reduces your risk a lot because a lot could happen in a shorter period of time. So you're you're mitigating that risk that the stock could go up and down a lot by doing dollar cost averaging and averaging out to this general trend instead of buying at a high where you could end up missing out on a lot of money. So that's a pretty important concept that a lot of people like to do. So now I want to talk about. We're almost done. This should be the second to last concept that I talk about, but this is really, really important. I know I said it a lot, but this is truly like very important. The idea of penny stocks. I'm gonna drink a bit of water because I don't know if you can hear, but my voice is dying right now. So hopefully, I'll be able to last until the end of the video. We're almost there. So there are a wide variety of definitions for a penny stock, but the common definition is a stock that trades for less than $5. Shoot. Less than $5 per share. This looks terrible. I'm sorry about that. Less than $5 per share. And usually, penny stocks are going to be shares of small companies. So why am I warning you about these? It's because penny stocks can seem very, very attractive, right? Especially if you don't have that much money. Penny stocks they seem like a really good deal because they cost so little per share. So if you only have $5 to invest and you see that this company has a share that costs only $5, you'll be like, oh, I'll just buy that. But it's a trap. It's a trap. Avoid them. This is where the dramatic music comes in. Avoid them. There are many, many reasons why you should not invest in penny stocks. Big one, they're very volatile. The price of a penny stock, if you look up any penny stock, the price can randomly jump very, very high to a very, very low price in one day. In one day, they can jump very, very high to very, very low. So it can be really, really, really scary to look at them. If you Yahoo Finance has a list of if you just Google like top stock gain, I'll put it here, top stock gainers, and then top stock losers. Yahoo Finance will show you the stocks that made the most gains in the day and the stocks that lost the most value in the day. And it's almost always both of these lists are almost always topped by penny stocks, by stocks that cost less than $5 per share. So that just shows you how volatile they are. Sometimes they'll gain a lot of money in one day. Sometimes you'll lose a lot of money. So one reason. Another reason, they are often traded through the OTC. That stands for over the counter. Traded through the OTC. Remember when I talked about stock exchanges? Most major stocks are traded through an exchange like the New York Stock Exchange or the NASDAQ, which are the big stock exchanges. OTC is not as regulated. remember when I talked about public companies requiring that you release financial information? The OTC is not as regulated as the NYSE or the Nasdaq. Oftentimes, there's very little financial info on these penny stocks that are traded OTC. And you'll especially see the importance of financial information in the next video, where I dive much deeper into this idea of financial information. But there's very little info on them, so it's very hard to make an informed decision. So that's why another reason why they're risky. Another thing is low liquidity. Typically, penny stocks are not very commonly traded. You'll see, like, remember I said the typical volume of a stock is between 1 and 10 million. For these, you might see a volume of like 10,000, which is very small. So if you buy a stock and it crashes, and then if you buy a penny stock and it crashes and you want to sell it, it can be very hard to find people that are willing to buy it, because there's so little people that are trading the stock. It can be hard to sell it. So that's another reason why you don't want to buy these, because it can be a trap that you can't get out of. And then finally, oftentimes penny stocks are going to be small companies that are nearing bankruptcy. Think about it. These stocks are not doing very well. The companies are not doing very well, so people are selling their stocks, and the stock is just being pushed down like very heavily. There's a reason for that. If a company's price is low, there's typically a reason for that. It's because the company's not doing very well. So typically these companies are going to be nearing bankruptcy, and then if you buy into them, then you're just asking to lose all your money by it going to zero. So there's 4 big reasons to avoid these penny stocks. I know it can seem very tempting, but please do not buy them. They're a trap. Finally, last thing I want to talk about. This is very important. I think a lot of you will be very interested in this. So pay attention we're in the home stretch here. Fractional shares. This is super cool. Fractional shares, they allow you to buy only a fraction of a share. So buy a part of a share. So you buy a part of a share if you don't have enough money to buy one full share. For example, Amazon right now, it costs over $3,000 per share. Over 3,000. Who has that kind of money to buy that? Like, especially if you want to buy like 10 shares of Amazon, who has that much money to buy if one share costs $3,000 per share? Let's say you only have $100. If you only have $100 to spare, but you want to buy Amazon, because Amazon's a great company, right? I talked about it's a FANG stock, really good growth stock. So if you only have $100, then you can buy $100. Each share costs $3,000, so you can buy 1/30 of a share. So this is really powerful, right? Because you can buy these stocks that you normally wouldn't be able to buy, but using fractional shares. One thing to note though is that you'll see that you're not going to get, like, if you buy a stock for, let's say you buy Amazon stock for $3,000, and it goes up by, let's just say, 10%. Then 10% of 3,000 is what, $300? So now you're gonna have $3,300. If you buy the fractional share of $100 and it goes up 10% as well, 10% of $100 is $10. So you'll have $110. Now you may be like, oh man, $110 versus $3,300, like that's nothing. That's like this is nothing compared to that. But you have to consider that we're talking about percents here. So and percents are really the name of the game in investing, because you put in less money. You were only able to put in this much money, yet you were still able to reap the full benefits of that 10% gain. It's all based on what you put in, right? The percent gain is the same. So so what I'm trying to say here is that although it seems like you're getting less money, like $10 versus $300, like remember, the percent is based on what you put in originally. So this is still like a very impressive gain. A 10% gain is still a lot. Like if you so I know that might not seem very clear. Hopefully that you get the point of what I'm trying to say, is that don't be discouraged in the seeming lack of profit from the fractional shares. Like this is still very good. 10%, like it's basically the same amount, the same thing as this. The flat amount is much less, but the percent gain is the same. And so that's really what's important here. We want to look at the percent gain, not the flat amount. So so I know that was like kind of like a tangent, but I did want to make a point there in that, like, don't be discouraged in like the difference in the flat amounts. So going back to fractional shares, so the reason why they're so good is that, like, you see how it can allow you to invest in really good companies even if you don't have enough money. Like Amazon is a great company, FANG company, but it's so expensive. But the idea of fractional shares will allow you to buy them. I do, however, want to touch on some drawbacks. I'm running out of room here, but hopefully I can squeeze everything in. Drawbacks. It can be hard to sell a fractional share. Because most people buy full shares, right? Because the vast majority of people will buy one full share of Amazon. But if you buy a fraction of a share, it can be pretty hard to sell it, because most people aren't going to want to buy like that fraction. Another really big drawback is that not all brokers are going to offer fractional shares. Fractional shares they're kind of a new concept. Let me move this over. They're kind of a new concept. So not all brokers have like evolved to allow them, but there are some really good ones that do. Some good ones that do are E-Trade and Robinhood do. And this is pretty convenient, right? Because you may recall in the intro to stocks video, I said that these two brokers are really good in particular, and it turns out that they do allow you to buy fractional shares, so that's even more reason to use them. So that is one thing to note. Though, if you want to buy fractional shares, do your research. Make sure that the broker you choose will allow you to buy them. And one really cool thing that I want to touch on. This is not a drawback, but you draw lines that you know that this is not a drawback. You can buy fractional ETF. Right, because an ETF is basically just a stock. So the ETF that tracks the S&P 500 is the ticker symbol is SPY, SPY. That's the name of the ETF, and so SPY, I believe right now it costs a little over $400, which is a lot of money. So if you only have, like, say $10, you can still buy into SPY. You can buy into this ETF, and remember, like, the ETFs they're very good investments because they're so safe, and they still give you a huge amount of return. And so, like, this is pretty crazy, like crazy powerful, right? Because as I mentioned, like, ETFs are really good. They're very strong, but they're pretty expensive. The SPY is pretty expensive, but fractional shares are going to allow you to buy into this powerful ETF that will allow you to get a lot of return with minimal risk as well. So that is why fractional shares are so powerful, because you can buy these really good ETFs and stocks without even if you don't have the amount of the money needed to buy them. So that's the last thing I wanted to touch on. Hopefully, you remember at least I guess I'll go over the really important ones I want you to know. Diversification is really good to know. Penny stocks, right here, and fractional shares are really important. And I think that especially fractional shares, I think you'll be very interested in. You can they're pretty powerful. So hopefully, I know that this video, wow, we're at 45 minutes. I ran a lot longer than I wanted to. I actually wanted to keep this down to about like 20 to 25 minutes, so I went way over time. But hopefully the detail there wasn't too boring. I hope that you learned something, as usual. Next time, I'm very excited. We're going to be talking about fundamental analysis. Very important. So stay tuned for that. See you next time.